Take-profit order. A take-profit order is a trade instruction to sell a cryptocurrency at a specific price in order to secure profits. It is a risk management tool used by traders and investors, but its execution is not guaranteed. Tangle. Tangle is a distributed ledger technology used by some blockchain networks, including IOTA, which allows for faster and more scalable transactions. It uses a directed acyclic graph data structure to store and validate transactions through the confirmation of two previous transactions by network participants. Tangle networks are more decentralized and resistant to attacks than traditional blockchains, but may have lower security and require computational power from participants. Technical indicators. Technical indicators are statistical measurements used to analyze the behavior of a financial market or asset, such as a cryptocurrency. They can include trend, momentum, volatility, and volume indicators and are presented in chart or graph form. Technical indicators are often used in conjunction with other analysis tools and techniques to provide a more comprehensive view of the market and inform trading decisions. It is important to carefully consider the limitations and risks of using technical indicators and to use them as part of a well-informed investment strategy. Testnet. Testnets are versions of a blockchain network used for testing and development. They use different rules and parameters than the main network and are populated with fake tokens to simulate real transactions. Testnets are an important tool for developers and researchers to try out new ideas and technologies in a controlled environment and for users to test new applications and services without the risk of losing real funds or affecting the main network. The merge, ETH 2.0. The merge was a historic moment for the Ethereum network, as it marked the integration of its new proof-of-stake consensus layer, the Beacon chain, with the original mainnet. This integration eliminated the need for energy-intensive mining and allowed the network to be secured using staked ETH. The merge represented a significant step towards realizing the Ethereum vision of increased scalability, security, and sustainability. The first phase of the merge took place on September 15, 2022. Ticker. A ticker is a shorthand abbreviation or symbol used to represent a cryptocurrency. It is often used on exchanges and other platforms to identify a specific cryptocurrency and is used in market data to track its performance. Tickers are made up of letters and numbers and are used widely by traders and investors to identify and track cryptocurrencies. Timestamp. In cryptocurrency, a timestamp is a record of the time at which a particular event or transaction occurred. It is used in blockchains to record the time a block was added and transactions were recorded, and in smart contracts and other distributed ledger technologies to record the time a contract or record was created or modified. Timestamps are important for the security, integrity, and functionality of cryptocurrency and blockchain systems. Token. Tokens are digital assets representing a specific value or utility that can be created and traded on platforms like cryptocurrency exchanges and DeFi platforms. They come in different types, including utility tokens, security tokens, and stablecoins. Tokens can be created through mechanisms like ICOs or smart contracts and play a central role in the cryptocurrency and blockchain ecosystem. Token Generation Event, TGE. A token generation event, TGE, also known as an initial coin offering, ICO, or initial token offering, ITO, is a fundraising mechanism where a project issues a new cryptocurrency or token and sells it to investors for funds. TGEs are used by some cryptocurrency and blockchain projects to raise capital and are typically conducted online, open to both accredited and retail investors. However, TGEs are not subject to regulatory oversight like traditional securities offerings and have been associated with some cases of fraud and misconduct. Token sale. A token sale, also called an initial coin offering, ICO, is a fundraising method used by cryptocurrency and blockchain projects to raise capital. In a token sale, a project issues a new cryptocurrency or token and sells it to investors in exchange for funds. These funds can be used to finance development, marketing, and other activities. Token sales are conducted online and may be open to various types of investors, but they are not subject to the same regulatory oversight as traditional securities offerings and have been associated with fraud and misconduct. Investors should be aware of the risks and do thorough research before participating in a token sale. Tokenize. Tokenization refers to the representation of an asset or value as a digital token on a blockchain or other distributed ledger technology. It can be used to facilitate the exchange and tracking of physical assets, such as real estate, and financial instruments, such as stocks, as well as intangible assets. Tokenization has the potential to improve efficiency and transparency in asset management. Tokenomics. Tokenomics is the study of the economic principles and behaviors related to the use and distribution of tokens within a particular network or ecosystem. It includes topics such as token design, issuance, circulation, use as a means of exchange or store of value, and incentives for adoption. It also includes economic and financial factors that impact token value and demand, such as supply and demand dynamics, market competition, and regulation. Tokenomics is interdisciplinary and important for understanding the economic foundations and dynamics of the cryptocurrency and blockchain ecosystem. Total supply. In cryptocurrency, the total supply is the number of units of a particular cryptocurrency that exist or will be created. It affects the potential market capitalization and circulation of the cryptocurrency and can impact its value. The total supply is often fixed and determined by the cryptocurrency's protocol, and it can be limited or unlimited. It is important for investors and traders to consider the total supply when evaluating a cryptocurrency and its potential for price appreciation or depreciation. Total value locked, TVL. TVL is a measure of the total value of assets locked in a DeFi protocol or platform. It is used to track the size and activity of the protocol, and it is an important metric for both protocols and investors. TVL includes the value of cryptocurrencies and other digital assets, such as stablecoins and NFTs, and it can impact liquidity and stability within the DeFi ecosystem. Trade volume. Trade volume is the total number of units of a cryptocurrency that are traded or exchanged over a specific period of time. It is used to measure activity and liquidity, and is often used to gauge demand for a cryptocurrency. Trade volume can be measured in units or value and is important for investors and traders, as well as exchanges and marketplaces. Trading bot. A trading bot is a software program that automates the process of buying and selling cryptocurrency on an exchange or platform. It executes trades based on predetermined criteria or algorithms and can operate continuously. Trading bots can be used to trade a variety of cryptocurrencies on various exchanges and can take into account market trends, technical indicators, and fundamental analysis to make informed decisions. They are often used by professional traders and investors to automate their trading activities. Transaction, TX. A cryptocurrency transaction is the transfer of value or assets using a blockchain or other distributed ledger. Transactions are initiated using a digital wallet and processed by the network using a distributed consensus mechanism. Once processed and validated, they are recorded on the blockchain and become a permanent part of the network's history. Transactions facilitate economic activity and exchange in the cryptocurrency ecosystem and enable a range of applications in the broader blockchain ecosystem. Transaction fee. Transaction fees are small amounts of cryptocurrency paid to process a transaction on the blockchain. They are paid to miners or other participants who validate and process the transaction and incentivize them to secure and maintain the network. Transaction fees vary based on the type and size of the transaction, demand for processing power, and network congestion. They are an important part of the cryptocurrency ecosystem but can also be a source of frustration for users due to fluctuations and high costs during times of congestion. Transaction ID, TXID. A transaction ID, TXID, is a unique identifier for a cryptocurrency transaction recorded on the blockchain. It is used to identify and track the transaction and verify its status and details. The TXID is generated by the network when the transaction is processed and is based on the transaction's sender and recipient addresses, amount of cryptocurrency transferred, and timestamp. It is a long alphanumeric string that distinguishes one transaction from another. TXIDs are important for tracking and verifying transactions, as well as for discussing and troubleshooting them. They also play a role in enabling and facilitating blockchain applications. Transaction per second, TPS. Transaction per second, TPS, is a metric that measures the capacity of a blockchain or distributed ledger technology to process and validate transactions. It is expressed in the number of transactions that can be processed within a specific time period, such as 1 second. TPS is used to gauge the efficiency and performance of a particular blockchain, and it is an important consideration for cryptocurrency projects, as it can impact scalability, cost, and user experience. TRC20. TRC20 is a standard used by the Tron platform to create and issue tokens on its blockchain. TRC20 tokens are digital assets that can represent various values and assets and are compatible with the Tron blockchain and other TRC20 tokens. They are created using smart contracts and can be traded on various exchanges. TRC20 tokens are used for economic exchange and enable various applications and use cases in the Tron and cryptocurrency ecosystems. Trustless. A trustless system in cryptocurrency refers to a system that does not require intermediaries or third parties to establish trust between parties. Instead, cryptographic techniques and protocols are used to ensure security and integrity. Trustless systems enable peer-to-peer transactions and exchanges without the need for a central authority or intermediary, reducing cost and complexity and improving security and privacy. They are used in the cryptocurrency and blockchain ecosystem for various purposes. Two-factor authentication, 2FA. Two-factor authentication, 2FA, is a security measure that requires two forms of authentication to access an online account or complete a transaction. It is used to enhance security by adding an extra layer beyond a traditional username and password. A common type of 2FA is using a device to receive a one-time code or passphrase via SMS, phone call, or an app, which is then entered in addition to login credentials. 2FA is important for protecting cryptocurrency accounts and transactions, and other online accounts such as email, social media, and banking accounts. Use case. A use case refers to the specific purpose or application for which a cryptocurrency or blockchain technology is designed. Cryptocurrencies may have multiple use cases, such as serving as a store of value, facilitating fast and secure payments, enabling privacy and anonymity, or serving as a platform for data storage and analysis. Ethereum, for example, is a decentralized platform that enables smart contracts and decentralized applications to be built and run without interference, while Bitcoin is primarily used as a store of value and means of exchange. Utility. Utility is the practical value or usefulness of a cryptocurrency. A cryptocurrency with high utility is widely used and solves a real-world problem, while one with low utility may not be widely used or offer any significant advantages. The utility of a cryptocurrency can change as the technology evolves and new use cases are discovered. It is closely tied to adoption, mainstream acceptance, and the underlying technology and features of the cryptocurrency. Validator. A validator is a participant in a blockchain network who verifies and adds transactions to the blockchain. In a proof-of-stake network, validators are chosen based on their stake in the network. In a proof-of-work network, validators, also known as miners, perform a computationally intensive task to validate transactions and are rewarded with cryptocurrency. Validators play a crucial role in the security and integrity of a blockchain network by verifying that transactions follow the rules and protocols of the network and reaching consensus with other validators on the state of the blockchain. Requirements for becoming a validator vary by network. Venture capital. Venture capital, VC, is an investment in companies or projects that are in the early stages of operation and are considered to have high growth potential. In the cryptocurrency industry, VC may fund projects such as blockchain-based platforms, cryptocurrency exchanges, or cryptocurrency-based financial products. VC firms invest large sums of money in exchange for equity in the company and often provide mentorship and expertise to help the company succeed. VC has played a significant role in the growth of the cryptocurrency industry, but investing in cryptocurrency-related ventures can be risky due to the volatile value of cryptocurrencies and evolving regulation. Vesting period. The vesting period is a time frame during which an individual or entity is entitled to certain rights or privileges, such as ownership or access to assets. In the context of cryptocurrencies, the vesting period may refer to the time frame during which an individual or entity is entitled to receive cryptocurrency tokens as part of a compensation or reward program. The vesting period is often used to incentivize individuals to remain with a company or project and can be structured in various ways. Virtual automated market makers, vAMMs. vAMMs are decentralized finance protocols that facilitate the trading of cryptocurrency assets on decentralized exchanges using algorithms. They calculate prices based on supply and demand and use smart contracts to manage liquidity. They offer benefits such as transparency and cost reduction, but also have risks such as liquidity shortages and smart contract security concerns. Virtual reality, VR. Virtual reality, VR, is the use of computer technology to create immersive, simulated experiences. In the context of cryptocurrency, VR may be used in virtual reality marketplaces to buy and sell virtual goods and services using cryptocurrency, or to educate people about cryptocurrency and blockchain technology. VR in the cryptocurrency space is still emerging. Vitalik Buterin. Vitalik Buterin is a co-founder of Ethereum and a well-known figure in the cryptocurrency industry. He developed the Ethereum Virtual Machine, EVM, which enables the execution of smart contracts on the Ethereum platform. Buterin is also active in the cryptocurrency and blockchain community, and is frequently sought out for his insights on related topics. Volatility. Volatility refers to the fluctuation in price of an asset over a given time period. In the context of cryptocurrencies, it refers to the change in price in a short period of time. Factors such as market demand, regulatory developments, and investor sentiment can contribute to cryptocurrency volatility, making them risky investments. Despite the risks, some are attracted to the potential for high returns and the possibility of profiting from price fluctuations. Volume. Volume refers to the total amount of a cryptocurrency that is traded over a given period of time. It is a key metric for evaluating the liquidity and activity of a cryptocurrency market. High volume indicates high demand and activity, while low volume may indicate less interest or lower liquidity. Volume can fluctuate and is influenced by various factors. Cryptocurrency exchanges often provide volume data, which can be useful for investors and traders, but it should be used in conjunction with other metrics and considered alongside multiple sources. Wallet. A wallet is a device used to store, manage, and transact with cryptocurrency. There are various types of wallets, including software wallets, hardware wallets, and paper wallets. Wallets allow users to view and manage their cryptocurrency balance, send and receive cryptocurrency, and view transaction history. It is important to keep the private keys associated with a wallet secure, as they can potentially access and spend the cryptocurrency in the wallet. Wash trade. A wash trade is a fraudulent activity that involves buying and selling a financial asset, like a cryptocurrency, simultaneously to manipulate the price and create the appearance of market activity. This illegal activity can mislead other market participants and artificially inflate an asset's value. It can be difficult to detect, as the trades may appear legitimate, and is more prevalent in decentralized exchanges that lack oversight and regulation. To avoid wash trades, be cautious when trading cryptocurrencies or other assets in potentially vulnerable markets. Watchlist. A watchlist is a list of assets, such as cryptocurrencies, that an individual or entity is interested in tracking or monitoring. Watchlists can be created on exchanges and other platforms to view current prices, market data, and other information for specific assets. They are commonly used by investors and traders to track investments, identify trading opportunities, and stay updated on market trends and news. Weak hands. Weak hands refers to investors or traders who are easily swayed by market movements and sell their assets at the first sign of market turbulence. It is often used in a derogatory way and suggests a lack of conviction or discipline in investment decisions. Strong hands refers to investors or traders who are more resilient and able to withstand market fluctuations, and may be more likely to hold onto their assets through market ups and downs. Web 1.0. Web 1.0 refers to the first generation of the World Wide Web, which consisted of static, hyperlinked pages of content accessed through a web browser. Web 1.0 did not have the interactive or dynamic features of modern web platforms. It paved the way for the development of the Internet and laid the foundation for more advanced web technologies, such as Web 2.0 and beyond. Web 2.0. Web 2.0 refers to the second generation of the World Wide Web, which allows for interactive and collaborative content creation and sharing. It includes social media, blogging platforms, and web applications that rely on user input. Web 2.0 has transformed the way people use the internet and has enabled the development of online communities and new business models. Web 3.0. Web 3.0 is a term used to describe the next generation of the World Wide Web, which is expected to include advanced technologies such as artificial intelligence and machine learning. It is expected to build on the foundations of Web 2.0, which introduced increased interactivity and user-generated content. Blockchain technology is likely to play a role in Web 3.0, enabling decentralized and secure online interactions. The specific features and technologies of Web 3.0 are not yet defined, and it is likely that new innovations will emerge as the web continues to evolve. Web3 Foundation. The Web3 Foundation is a nonprofit dedicated to supporting decentralized technologies like blockchain and cryptocurrency. It funds and supports developers and researchers working on decentralized platforms like Ethereum, and educates the public about the benefits of these technologies. The organization aims to create a more secure, transparent, and equitable internet through decentralized technologies, including cryptocurrencies. Its work is expected to positively impact the cryptocurrency industry by driving innovation and adoption. Whale. A whale is a large holder of a specific cryptocurrency who can significantly influence the price of the asset through their buying and selling activity. They are often closely watched in the market, but their actions may not always be representative of the market as a whole and can create risks for other traders. It is important to consider the potential influence of whales when making investment decisions in the cryptocurrency market. When Lambo. Lambo is a term used in the cryptocurrency community to express excitement about making significant profits from cryptocurrency investments. It is often used in a sarcastic or joking manner and is not meant to be taken literally. The use of the term highlights the high risk and speculative nature of cryptocurrency investing and the potential for significant price fluctuations. When moon. A moon is a term used in the cryptocurrency market to refer to a significant price increase. The phrase, when moon, is often used as a way of expressing optimism or asking when a particular cryptocurrency is expected to reach a new high price. Cryptocurrency markets are high risk and volatile, so it's important for investors to carefully consider their investment strategies and risk tolerance before making any decisions. Whitelist. A whitelist is a list of approved individuals or entities that are allowed to participate in a cryptocurrency offering or event. It is often used in initial coin offerings, ICOs, to manage participation and ensure compliance with laws and regulations. To be included on a whitelist, individuals or entities must typically meet certain criteria or requirements. Whitelists may be managed by the issuer of the cryptocurrency or by a third party and may be used in conjunction with other measures to protect against fraud. It is important for investors and traders to be aware of whitelists and the terms and conditions of any ICO or other offering in which they may participate. Whitepaper. A whitepaper is a detailed document that provides information about a cryptocurrency, blockchain, or other technology. It is typically written by the creators of the technology and outlines its features, goals, and potential uses. Cryptocurrency whitepapers are often used to generate interest and support from potential investors and users, but it is important to carefully review and evaluate the information before making any investment decisions. Yield farming. Yield farming is a strategy of providing liquidity to a cryptocurrency platform in exchange for rewards, usually in the form of a cryptocurrency. It involves participating in a liquidity pool and earning a percentage of trading fees or a token as a reward. Yield farming can generate passive income but also carries risks such as market volatility and potential losses. YTD. YTD, year to date, refers to the performance of a cryptocurrency or market from the beginning of the current calendar year. It can be used to track the progress of a particular cryptocurrency or market over a specific time period, but should not be the sole basis for making investment decisions. It is important to carefully consider the long-term prospects and risks of a cryptocurrency before making any investment decisions. Zero-knowledge proof. Zero-knowledge proof is a cryptographic technique used to verify information without revealing the actual information. It can be used in cryptocurrencies to verify the authenticity of transactions without revealing details like identities or amounts. Based on computational indistinguishability, it is a powerful tool for secure and private transactions, but requires a deep understanding of cryptography and math to be implemented correctly. Zero-knowledge rollup. Zero-knowledge rollup, ZK rollup, is a scalability solution for blockchain that uses zero-knowledge proof to verify transactions off-chain, maintaining security and integrity of the blockchain. ZK rollup allows for smaller, more efficient processing and verification of transactions, improving scalability for cryptocurrencies or other systems with high transaction volume or large user bases. ZK rollup is a complex technology requiring understanding of cryptography and mathematics. It has potential to improve scalability and efficiency of blockchain systems. Zk-SNARKs. Zk-SNARKs are a type of zero-knowledge proof that allow the verifier to verify the authenticity of a statement or computation without revealing its specific details. They can be used in cryptocurrencies to enable secure and private transactions by allowing parties to verify the authenticity of a transaction without disclosing its specific details. Zk-SNARKs are a complex and advanced cryptographic technique, and they are not widely used in all cryptocurrencies, but they have the potential to enable more secure and private transactions and interactions in the future. Zk-SNARKs. Zk-SNARKs are a type of zero-knowledge proof that allows the authenticity of a statement or computation to be verified without revealing the specific details. Zk-SNARKs are more efficient and scalable than other zero-knowledge proofs, making them a potential solution for verifying large numbers of statements or computations, such as in cryptocurrencies. In the context of cryptocurrencies, Zk-SNARKs can be used to verify the authenticity of a transaction without disclosing the details. They are a complex and advanced cryptographic technique not widely used in all cryptocurrencies, but have the potential to enable more secure and private transactions.